Hello, traders, and welcome to the second episode of these video series of sharing my setup and how I day trade and what I look at and what I use. So in the previous and first part, I was detailing the different tools that I use. Again, those are these specific tools I use. You can use any sort of charting software that you want. You can use any order book, any DOM if you want. You don't have to use the same tools as I use, of course. You can look at the same thing. There are multiple, um, choices out there of different solutions that you can use. Again, as I mentioned, the Sierra chart could probably cover everything I've showed you, but I choose to have Sierra charts and Bookmap, which is actually the visual representation that we have here. So it's the same thing as the actual numeric DOM, which is here on the right. And as far as the DOM is concerned, I use Jigsaw, and I've been using Jigsaw pretty much since it came out. So I was one of the very first users. Anyways, don't have to use the same thing, but what's for sure and what is key here is that you will need a DOM, depth of market, a ladder, as it's called sometimes, or an order book to be able to place your trades. I'll do a session on placing the trades and, adding and canceling and moving orders and adding limits and so on. But this is what I wanted to do here is really explain the functioning of not so much of the order book itself, but how this is visualized, what you're looking at here, and how really the mechanism behind price movement. Okay, and this is important. This is one of my old videos, by the way, because it's now Sunday and the market isn't live at that time of the day. So I'm just using a screenshot. It's static, but I'm just using a screenshot of one of the previous videos, which I had done years ago, and this was on the live trades on two different accounts. So anyway, and doing exactly the same thing on both accounts on that occasion. Anyways, so here you've got Bookmap, sorry, here on the left, and you can see the same thing you're seeing here. Now the really to explain a little bit the order book, of course, and I'm sorry if this is super basic and everybody knows this, but some people don't or don't necessarily get it. I've seen multiple videos on explaining the DOM, which, to me are fine, but I mean, I like to present it this way and understand it this way, and I want to share the way I look at it. Again, functioning is the same for any, it works the way it works, but I mean, there are some ways that you may want to look at it, and I think this is really much in line with what I'm going to show after and what I look at after, or at the same time, in fact, but that's going to come in future videos so that it all makes sense. Okay, now, so sorry if it's basic, but this is the order book. As you can see, you can set it up in different ways, and I've set it up, but what I have here in the middle is the prices, and really on each side here, right and left, you can see the resting orders or the limit orders. Okay, so those are all the resting and limit orders on the bid and ask. Here, you've got all the limit orders where you've got basically sellers, and here's basically buyers. Okay, so very simply, at 118.60 you've got 43 buyers. At 118.59 you've got 48. At 115.58 you've got 29, and so on. Okay, same thing here. 169 you've got 6 sellers. 62 you've got 57 sellers. 63, 34, and so on. Okay, so those really limits are just, you can add a limit yourself, so you can place a limit order yourself in the DOM. And this is really usually adding a limit order is if you want to buy or sell at a very specific price level. So if I want to buy or sell at 118.80 here, you've got 300 limit orders here. I would, again, I'll go through it when it's live. But I would add an order here and a limit order, a limit sell order, and I would be positioned 301. So before my order is taken, because there's a notion of a queue, right? Before my order is taken or is executed, if you like, those 300 contracts would need to be consumed, taken, executed, and then if I'm, in 301 position, then when those 300 have been consumed and executed, my order will be executed at that specific level. Okay, so that's simple. It works exactly in the same way for the buy side. And of course, in order to come to that level, I thought I had that level here, 118.80, all those limit orders would need to be consumed all the way up to here. And this is how the price moves up. And it's the same thing for the price moving down. You need to consume all those limit orders, all those buyers, in order to arrive to a level below. So that's effectively the mechanism of how the market works. And in order to consume those limits, we need to have market orders. And those market orders are those numbers that you see here, 2, 3, and 1. So that's really market orders are not orders that you want to take at a specific level. And market orders, they're deemed to be aggressive orders. So if I click on market orders, which you can see here, the MKT buy, the MKT sell, or ask and bid, those are really, if I hit that button, it's going to boom, execute the number of contracts which I have input here. Okay, obviously, which I can change 1, 2, 3, 5, 50, 100, or whatever specific number I want. Okay, those are the shortcuts. That's what it's going to do. And I hit market bid or market ask, and boom, it's going to buy or sell, and a market bid or ask order. Simple. So effectively, if I place a market order and I want to buy, my order is going to appear here. It's going to consume the liquidity available within the limit here. So instead of having 6, you would have 5 left. All right. And then in order for the market to go up to the next level, you would need those remaining 5 to be consumed as well by other market orders, buying market orders in that specific example, in order to move to the next level. And then those 57 here at 118.62 would need to be consumed to go up to 63. Those 34 would need to be consumed to go up to 64, and so on. So while the market orders are aggressive and execute straight away at a specific point in time, what really makes the market move is the relationship between the two. Okay, if there's no market orders, this will not move ever. Okay, you will have the same limits here on the bid, on the ask, and it doesn't really, move. They need to be consumed for price movement to happen, whether it's going down or it's going up. But those limit orders need to be consumed, and that's the relationship between the limit orders and the market orders, which can make the market move or not. Okay, so there are some specific examples where you could imagine that if the 6 orders were being consumed, but another number of limit orders were being placed at the same level, 118.61, that would still also need to be consumed again to go up. So as long as you've got liquidity here, and the liquidity is larger than the actual aggressive market orders hitting the bid, the price, again, will not move, okay? This is why you hear sometimes about iceberg orders. Iceberg orders just mean there's a large order, which is being placed little by little, rather than showing a full hand, like here, 300 or 200 or 316, or which is you can find sometimes you'll see, and look, usually in the inside bid, inside ask, so that's the bid ask, those limits tend to be smaller, and the more you go up, the larger they are. And it's a bit of a game, because market could go up to this consume 57, 34, 73, 74, 67, and when it comes to the 3 or 4, this 3 or 4 could suddenly be pulled out, disappear, and it could become a 2 or whatever. Once the inside, the bid is here, bid ask is here, and it could just consume those 2 and suddenly go up. Okay, so this is where really you may want to look at. You really need to understand the relationship, between the limit and the market orders. Okay, with that market orders, you won't have any price movement. With that limit orders, you wouldn't have anything to consume, so you won't have any offer. You don't have anything for sale, you don't have anything to buy. Okay, it's simple. Now, I hear sometimes, what's really important is the market orders, and because they're aggressive, and the limit are not so important. And it's all important. All right, it's like saying, when you sell your car, what's important is sellers and not buyers, or just buyers and not sellers. Clearly, if there's no buyer, there's no seller. If there's no seller, there's no buyer. So it's the relationship which is important. It's not so much one more than the other. However, what we tend to do is, as I say, the common understanding is that the market orders are the aggressive ones. They're in a hurry. They want to execute now. And if, that's whereas the limit orders are more, specific levels, price levels, and they've got more time, and there's not such a hurry, and they want to execute at a given price. So it is commonly, we commonly used to, it's commonly, common thing to say that, yes, it's the market orders which are important, but it's not specifically. The whole thing is important. Okay. Now, when we look at the footprint, which we'll look at in a minute, or when we look at a volume, obviously the volumes are calculated, and the footprints that we show, in the previous video, that would be, the market orders would be used to calculate the volumes, to display the volumes, and that's what we'll show on a footprint chart. Okay. But of course, this is really, if you think about it, this is not really market orders on their own. This is market orders which have consumed limit orders. Otherwise, they wouldn't have printed. They wouldn't have been executed. Okay. If there's a market orders now at 118.60, but there isn't any liquidity here. If there wasn't any liquidity, then they wouldn't be executed, because there's nothing to execute it on. Because here, by definition, the market orders that you see printed here are being executed, so they consume liquidity. Okay, so again, yes, they looked at being aggressive. Yes, they people say, well, that's what you used to calculate volume, that's what you used to display on footprint. Of course, but they only are here and exist because of the relationship with the limit. Otherwise, there wouldn't be any. Okay, you could have limit orders without having market orders, but not the other way around. Okay, so if you ask me, the equity is important, it's a relationship, but perhaps the limit orders are somehow more important. Okay, bit of a false debate, but I'm just sharing this because I so often hear the opposite, and I think when you look at it this way, it's it's slightly changes. So if this is really clear, we can tell that those market orders, again, only exist because it's a zero-sum game. If you've got one market orders, you've got one limit order on the other side. That's the counterparty. That's the other side of the trade. Okay, so those for each market order, you've got a limit order. Okay, so when we start to analyze those market orders, they are aggressive. They're being executed at some specific, at some levels that, they are being launched, if you like. Then, if we look at those orders, they will leave some. They will generate volume, and by volume, I don't really mean volume at price, but I mean volume at, volume at. Sorry, not volume. Usually at time, which you usually see volume bars here, but volume at price, volume on different price levels, and that's what really, when I was showing in the previous video, when I was showing, the volume profile here, this is exactly what we look at. Okay, I could choose to display the number of orders executed here if I wanted to. You know, I don't do it because I can't quite see the point of it. I prefer looking at it from a you know, from a total standpoint and a visual standpoint. But I could just do that. Okay, and if I do that, oh sorry, just showing me the total for the point of control here. But anyway, I could choose to display it on the actual chart, volume profile chart. I just need to find how to do it. I could look at it at a you know, a percentage. I could look at actual figures. I don't use it, so sorry. I'm sort of trying to look at the actual option to display it here, which I forgot how you do it, but you can do it. You can display it. Can't remember. Yes, there we go. There we go. Okay, so that's what I've done here. In addition to showing the colors, you can see I'm displaying the actual numbers, figures of market orders in there, as you can see here. So again, really the way to look at it is diagonally, okay? But anyway, the point being, this is being added horizontally on each price level so you can build a volume at price, okay? And those number here that produce those volume profiles are the market orders that, you know, we saw here. All right? So simple as that. And that's why I look at those, when I look at those volume profiles, whether I choose to have the numbers in there or not, it's not so important to have the exact number here. But visually, okay, you could tell that, hey, here you've got, that's where you have the most volume in the last session on Friday. That's the point of control. You see the total numbers here, but even visually you can see it. You can see that here we had very little volume. Okay, so that the market presumably went very quickly one side and another, and you know, and you could sort of see that here we spend quite a bit of time. So I've got a TPO here, so I can look where I spend the most time. You can see that here we didn't spend time here. It was really a drop, a very quick drop. And if you look at the time, 1:30, it was a US economic announcement, which had an impact on the market. A lot of market orders, you know, really were very aggressively hit the market. They all went to, you know, lots of sellers selling market orders, and really, you know, selling, consumed all the limit orders. I just showed you on the gram, and it suddenly dropped like a stone. And this is why we've got very little. There's a little bit, which I'm not sure you can see it on screen because it's, you know, dark and red. But so you've got a little, you know, volume here, but it really is minimal because it went so quickly. It consumed the liquidity so quickly and it went back. And then I see one here. It went all the way down here, and it went back up, and then it spent a bit of time here and quite a bit of time here as well. So that's the TPO, so the market profile, which is what I was showing you earlier. And this is where we spend the most time. And this is, you know, this is not the volume profile point of control. The point of control is in yellow here, but, you know, we're very close here. So the volume equally generated was fairly, was matching, if you like, the time where we spend quite a lot of time on in terms of hours and, you know, exchanging contracts really. You can see here we actually did spend a lot of time. Actually, the TPO, so market profile, TPO time point of control, as far as the TPO is concerned, where we spend the most time is here. So this is indeed where we you know, we produced, generated the most volume, exchanged the most contract. But here's probably the second place where we spend time and where we generated volume. As you can see here, we call that a double distribution. So, the market starts at a certain point in time and then it goes down, and then so you start producing, executing and generating volume, building up volume, and then it goes down suddenly, and then, it spends more time accumulating volume in a second distribution down below. Okay. Then we will, of course, look at the different type of profile that we have, and that will give you different type of information. Here you can see in the session before, we had a very, well, it's fairly balanced. So each time we went to the top, we sold. Each time we have a little spike at the bottom, but then we bought back. And so it was really, you get to the top, you sell, you get to the bottom, you buy, and that's how the market worked on that day. Okay, but importantly here on that day, it was what we call an inside day, because it's inside the previous session, the previous day. And then you have, some rules, so to speak. And again, I'll go into the details of those, but those rules say, when you have an inside day, and if on the following session where you had an inside day the day before, if that session goes below the low or the high of that previous inside session, then you would go at least all the way down to the session before the inside one, or if it had went up all the way up to the the session before the inside. And you've got outside days as well, which is something similar. But really, that was an inside, and it's exactly, well, we went way below that because it was this economic announcement that pulled the market down and so on. But we certainly did go way below the session before. You've got another example here. Inside day. On that occasion, if sort of open it so you can understand a bit more what happened here. But it went up, the whole session. Here, we go up the whole session, and we end up having an inside day compared to the previous session. And then we went up clearly here on the following session, and we very easily broke the high of that inside session, and we smashed the top of the session before, and even went all the way up to the session before that. Okay, so you have, it's the same with outside days, the same with inside days. There's quite a lot of things like that, which again, they're not 100%, but I don't know what a percentage is. I'm not going to make one up, but the point being, they work more than they don't work. Okay, and it's not something you take a lot of risk watching, because they happen more often than not, and to some degree it can be a self-fulfilling prophecy in the sense that everybody's expecting the same thing, and they will react if they start seeing it going in one way, and that will in itself push the market. Okay, now that's one thing. That's looking at the different distribution, triple distribution, inside days, outside days. You could look at, as you can see here, I'm projecting all kind of things. I'm projecting, and that's going to be for several other sessions, but I'm projecting point of control because that's where the most volume occurred. So I put a line which is extending going forward. So that's going to act as a magnet. The same for the footprint when you've got single prints or unfinished business at the bottom or at the top of a session, which again will mean that the market will very often finish the business and revert, or at least go back to those points and complete the execution. All of that we will detail and explain a little bit more the functioning behind it. But I think what's important here is that you understand that this is not made up of thin air, and the reason why this works, it's not because it's just random rules. It's because this is based on actual exchange between buyers and sellers. All right, the market and the limit relationship that we just saw on the DOM. That's the reason why it works, because that's what happened, the transaction that happened. Okay, and somebody who may well be in a transaction where at the top of a session, for example, when you start looking at those market orders, somebody who's long and the market is going up is going to be in a completely different position than somebody who's long and the market is going down, which means they will have to either effectively get out of the position to, in profit, to take profit, or just because they are not in the right, they're losing money, they want to get out, they want to exit. So again, it's all when you start. I know it may be still confusing now, but when you start looking and digging into it, and when we will do this more and more, you'll start to understand really why this makes sense and why it works. Okay. Now, there are other rules I'll go through when you've got thin volume tail, selling tail, buying tails. When you've got single prints coming for the footprint, when you've got low volume nodes or high volume nodes or point of control, and that's those lines that you can see I'm extending here. In fact, I probably always need to haven't been clearing my chart for a bit, but there are a number of events in the volume profile that you want to project. So here we've got clearly, as we mentioned, a low volume node here. I would extend it a little bit here, probably from here to here, and I'm projecting it. As you can see, I'm drawing a rectangle scenario which I'm projecting in future here. Okay, so in the next session, if we go back up, we closed here, so I don't know which direction it's going to go, that's for sure. And if I did, I would be delighted, but I'm not. And you can see we're projecting this session. So if you go back here, those low volume nodes tend to be revisited and very often filled in. All right, which means when you see a low volume node like that, the market comes back here, acts as a magnet, and very often some volume will be produced here. Time will be spent here, volume will be exchanged here. All right, and you could do another one here because we've got a low volume. Well, it's more of a selling tail here, and I'm always trying to make those. I do it in a volume, but I also look at the TPO here as well. The market profile in itself has very can be very complex and very detailed, and some people are really good at it. I use it in a more, and some people say, hey, it's great, but it's old-fashioned. The market don't always look the way they used to work, and I think it still do. But at the same time, it's one of the things where I don't look at all the market profile concepts. I use the ones which I've experienced worked more often than not, and which I like to combine with my volume profile. And again, that's why I want to compare side by side the TPOs, the market profile and the volume profile. But again, this is exactly when you start looking at something and you make it your own. Okay, you don't say, hey, I was told this, that's what I'm going to do. No, it's more, I was told this, I tried it, it works, I like it, and I want to carry on using it. That is more, looking at something else, you may think, well, that's more, not sure about it. And look, you should do what you're sure of, not what you're not sure of. Okay. You can see here as an example, we've got this large rectangular here, rectangle, sorry, even. And if I go back in time, and it can go a long way, it can go, it can come from a long time ago in the past. I don't even know when this, what this relates to even. Trying to squash a little bit the chart going back in time. Now you can see we're going back seriously in time. And the reason we're going back seriously in time, because the level of the euro dollar hasn't been at that level for quite a while, all right? But anyway, so we're going back in that, to that level literally years. And I had done exactly that. I don't know where it is. I don't want to spend more time than I've already spent in this video. Oh, there we go. Okay, there we go. That's why that was a long time ago. That's probably why I've drawn that rectangle here. All right. I've lost it now. God. Okay. Anyway, you can see it's something where you could easily, we're talking about 2022 here, okay? So that's 3 years ago now. And you start drawing those rectangles, you project them forward in time, and you forget about them, and sometimes the market will completely go in the other direction and for years, and you forget about it. All right. But I do that for the daily volume profile and market profile, but I also look at the weekly, as I mentioned in the previous video, and also the monthly. So they all have a different, probably validity, but they're always valid. But you know what I mean. It may take a while before the euro dollar comes back to the levels it was at, and it is at today. In fact, as we've just seen, it was 2 years ago. Last time it was so weak, 1.02. All right. So really, it can take time. It's not so much a guarantee that when it will go back. You don't know. We don't know. Okay. I mean, I'm here. I've got this whole red zone which I've projected, which goes down all the way to 108, 200. Maybe we will never go there. Maybe tomorrow's session will go up forever for 3 years. I don't know. But you can be guaranteed at some point we'll come back here. And when we come back here, all of this is, if we start going there tomorrow, you can look at this tomorrow morning and you'll see that it wouldn't be surprising if we go back to 101.11, and that's where we were 2 years ago. And this is where we had a low volume node, which was projected forward, and we'll find that this works. Okay, and this is, again, the reason why it works, because it's this relationship between market and limit orders, and that's how the market works, and that's how the prices move, and that's why you've got people who probably are still in positions 2 years ago. When I say people, institutions, that's the thing about the market. You don't know who's in there. You could have very large pension funds, you can have hedge funds, you could have and different type of strategies as well of hedge funds, and you don't really know why they're in here. It could be for various reasons. You could have whenever there's anybody buying equities in a different currency that their portfolio or fund is nominated in. So if you sell, to be simple, you've got a US fund, US dollar fund, and you want to buy something in euro, you can, but automatically you'll have a currency operation, if you like, in the background, which automatically is going to apply, and that's going to generate in that example, if it's euro and dollar transaction. Even though that's not the actual intent originally, it was not a euro dollar transaction per se. It was something completely different. A European or an American firm buying something in Europe, or vice versa, that would have generated a foreign exchange, execution, because it's from one currency to the other, and that's the forex market. And the futures, the forex market is the underlying of the euro dollar futures, and that obviously tracks and the underlying the spot. So as an example, you could have had a fund who had to buy a lot of currency, dollars, a while back, and did that 2 years ago. You could have, we could spend an hour thinking about why. In the end, it doesn't really matter. But just to say what I was saying in the first video is just to illustrate, everybody's got a different agenda. You don't know who those firms are. You don't know what they do. You don't know why. And hey, it doesn't matter. Who cares? It doesn't matter. But what matters is that we can look at it. We can see where volume was produced and exchanged, and where it wasn't, where there's a real gap, when there's a real low hole, low volume node, very high one, where we had a previous volume pot of control, where we had single prints, when we had buying tails, when we had selling tails, when we had unfinished business, because the market will always revisit there, because it's a transaction between buyers and sellers, and people are taking a side. So if you're one way, you need to get out the other way. Your counterparty, which nonetheless being a limit, will have exactly the same thing. So this is really what we're looking at here, and that's why this works, so to speak. And what I was coming out earlier, I was saying this is not so much, the question isn't, will we go back here in this level of node? Will we go back in this one? Will we If I just, trace another, there's a little gap here, which I did the other way, the wrong way around. There we go. There's another one here. So regardless of what's going to happen next, all right, the question isn't, are we going to go back here? Are we going to go back here and produce volume? Are we going to back? You can see here, there was one which I did, projected it forward. Guess what? We did volume here, all right? I can give you thousands of examples on this chart alone, going back in time. So the question isn't so much, does it work? The question is, when will it work? And that's something we don't know about, and sometimes it can take time. Okay, you can see here, there's one, I don't know where it comes from. It comes from here, all right? Projected it, start doing volume. It doesn't happen in one session necessarily either. It can take several sessions to fill in that gap of very low volume nodes. A little bit of volume here, a little bit here, a little bit here, a little bit here. We didn't, I think here in that specific example, we could probably go here and reduce it from here to here. I would say, hey, we've covered most of it. And really that's what remains to be filled in. As an example, that's the way I look at it. And, anyway, I'll going to stop here because it's already 36 minutes. It's long. I'll have other sessions more on that, more on the footprint, and more on anything else that I look at. But really, I wanted to start with that specific functioning because it all starts from here in any market, all right? And this, by the way, is just looking at the same thing as that, but instead of seeing those limits here as numbers, you see them in numbers, in fact, but you see them as colors. But otherwise, you're looking at the same thing. And before you think, oh, why do you don't have the same numbers here and there? Because here I'm looking at, it's a different contract. It's a euro-dollar contract, but it's a mini, and it's a micro. Here's a mini. All right, so I like to look at the full volume. So that's the 6E, that's the M6E in this specific example. They obviously are correlated, but I just like to look at the original. I could look at this one as well, but I like to look at the original, the larger contract, if you like. That's why you've got different figures. But really the relationship and the size of the limit might be different, but the actual importance of them will be correlated. So it's exactly the same thing here. All right. Now, wish you a good rest of the weekend and evening. If you've got any question, any comment, please don't hesitate. If you want to subscribe, please do, so you can get alerted when there's another video. Sorry if it was long, but it's super crucial to understand that. Otherwise, there's not even a point looking forward. And trying to understand the rest. So that's the base. Thank you very much. See you in the next one.